Welcome to the Grow Your Business and Grow Your Wealth podcast with Gary Heldt. Gary is an expert in helping business owners put together a plan that will provide a better future for their businesses, themselves, and their families. On the podcast, Gary interviews other professionals who share his vision, and together they share secrets and strategies any business owner can use to build a better financial foundation for your business and your life.
Welcome back to the podcast. Today, our guest is Simon Popple, who is the managing director with Brookville Capital, and he's also the writer of the Intelligence Reports. Good morning. How are you?
I'm very good, thank you. Very good. How are you?
Good. Thanks for joining us. Tell us, what made you pursue a career in finance?
Well, I actually started out in marketing, and I took back in the day the typical route was do an MBA and then kind of find your sort of niche in life. And I loved investment banking. I liked corporate finance, buying and selling companies, and it's been a really good discipline for business. Understanding how companies work, how they generate cash, and how they some have got great futures. Some of the futures aren't so good, but it's a very good grounding in business.
So tell us how you got from just starting out to now you're the managing director with Brookville Capital, and you're writing your own intelligence report. Tell us how you got there.
Sure. Well, I mean, I sort of started out in investment banking, and I went into property and worked for. I was head of investment management of a decent sized business in London, and then I became a director of one of the world's largest private real estate companies. And when I was there, the guys, they were billionaires, and they had a lot of people knocking on their door with good ideas. And I found a lot of them were in sort of commodities. So they'd made their money in property, and I wanted to move into commodities. So I started basically trading myself and doing my own stuff, and I did pretty well, to be honest, and so well that Money Week approached me and asked me if I'd write a newsletter for them, and I did that, and that went very well. And then they sold out, and the people who owned it, rather than let me go with the business, they asked me to write a newsletter with a guy called Jim Rickards, who's quite big in the US. So I wrote Gold Speculator basically for their non-US clients, and I did that for a few years until they closed down the UK. And but I kind of got the bug then, and I was making good money, and so I decided to stick with it and do my own report.
So what is it about commodities that kind of really sparked your interest and made you kind of go in this direction?
Well, initially it was really, the kind of returns you can get, particularly from the junior gold and silver miners, because if you look at previous booms, the good ones have gone up 10, 20, 50, even 100 times in value. So for me, that was pretty exciting. But obviously I've been in the industry for a long time now, and over the years, you sort of, let's say, you become a bit more careful about how you allocate your capital. And even though some of the investments I've put my clients into have done phenomenally well, such as Chalice, which I think it's gone up about 25, 30 times since I told people about it. But commodities, they're tangible assets, they're real things, and I've always liked tangible assets. Some of these things that are out there at the moment, if I'm honest, I don't really understand Bitcoin and a few things like that. So I like tangible stuff, and because commodities are tangible, they're used in society, they're used in our everyday life. It's an area that sort of drew me to it, and not only out of interest, but the ability to make a lot of money.
So when you talk about commodities, I mean, what items fall under the category of commodities?
Well, I mean, I think that if you're just starting out in the sector, I think that there's a lot to be said for having some gold and silver and precious metals in your portfolio. But there are so many commodities. I mean, to have a really broad commodity portfolio, you could add rare earths, you could add lithium, nickel, zinc. There's a really long list, and that's just the hard commodities. And then, once you've got your hard commodity portfolio, you may want to go more into soft commodities such as wheat, corn, soya, and you can build a really good diversified portfolio. And all these companies are different, and that's a lot of the value that I add to my clients, because I kind of explain the difference between, let's say, a producer and an explorer. But particularly, let's say, gold companies, they pay nice dividends. Not all of them, but a lot of them do. And in these interesting, challenging times, finding companies that can pay good dividends is not easy.
So, in talking about the different commodities, and you're saying that with starting out with hard commodities being gold, silver, things like that, what is it about those commodities that you really like?
Well, as I said earlier, you can't print them, and right. I think that the fact that there's a finite amount of them is attractive from an investment perspective, because that you're investing in something that can't be created out of thin air. So I think that's very attractive, and they're used in everyday life as well. They are very important parts of our lives. And to invest in something that is used in many, like silver, it's got so many different uses. I find quite exciting.
I guess, how is it with the commodity and trading it is different than trading a stock or a mutual fund or something like that?
Well, I mean, I personally, I like the companies rather than buying and selling the actual commodities themselves. I specialize in looking at commodity companies, and for me, that's, on the one hand, you're slightly at the mercy of the markets. The markets are smart. They know where the value is, and I think that if you're investing in a company that's got a real tangible asset, it doesn't rely on let's say retail, for example. There are certain companies that are heavily reliant on retail, and a lot of commodities, they're not. And so, especially gold. I mean, gold. The value of a gold company is largely to do with the deposit and the plant that they've got to actually process the ore, which is all in one location. So you've got a fairly small or short supply chain. So, in the case of, let's say, a gold or silver company, you probably find that sort of 80%, 90% of the value is actually created on site. I like that, especially in these with the pandemic around us, companies that have got long supply chains that need to move products all over the world to make their supply chains work, I think can be quite challenging.
Yeah, it definitely, with everything that's gone on with COVID, it definitely seems that right now that this would be a great, a great investment. How does someone go about, starting to invest in commodities?
Well, I mean, I think the first thing you need to do is, do your own research. Goldman Sachs have got a very good index, the commodity index. So I'd sort of suggest people have a look at that, because that indicates that I wouldn't say it's right at the bottom, but it's sort of towards the bottom of, and I think that will whet the appetite if you see where prices are as on an index basis compared to where they have been historically. And then I think that people really want to decide what level of risk they want to take, how much they want to allocate to the sector, what sort of companies they're looking at. There's some gold, silver juniors which are pretty speculative, but you can make phenomenal returns. but there's other areas where you perhaps want to be a bit more conservative, and perhaps you want a dividend, or perhaps you've got a real view about electric cars or a certain sector, and if you've got a view about a certain sector, then you can look at the commodities that are very important for that sector. So in the case of electric cars, probably lithium, cobalt, nickel. Yeah, I mean, I can help people look at companies, and that's what I do. And but yeah, I think a lot more people should be looking at it, because it's a good diversifier as well. And especially if people are, let's say, in real estate and things like that. It doesn't have a negative correlation to real estate, depending on what sort of type of real estate you look at, but it certainly doesn't correlate particularly well with real estate. So I think it could be a good diversifier for people with that sort of portfolio.
So how do you differ from, say, a financial advisor that somebody goes to, or a financial planner that somebody goes to, and gives them their money and says, okay, here, invest it for me?
Well, first of all, I don't touch anyone's money. It's for them. What I do, I specialize in commodities. That's all I do. I don't, if you look at a financial advisor, they're more to do with portfolio allocation. They look at all different asset classes. I just focus on commodities. And so people tend to come to me when their financial advisor said, look, you should look at commodities, but I, as a financial advisor, don't know anything about commodities. And then I can give them some ideas based on whatever the brief is, and then they can go and discuss those with their financial advisor, and he can give them the proper advice. But what I'm really doing is sort of providing people with the kind of research and insight into the sector, which they find it difficult to do outside of a fund. And I'm really offering an alternative to a fund. I mean, if you want to just invest in a commodity fund, then that will probably give you exposure to a lot of commodity companies. But obviously there's performance fees and management fees and everything like that. Whereas what I try and do is build a portfolio that's more sort of suited to whoever the investor is, and it's part of their portfolio. They've got complete control over what they want to do, and people seem to like that.
So in dealing with the commodities and things like that, I'm assuming that this is pretty liquid.
Yeah, I mean that's one of the great attractions, actually. I mean, if you're talking to people about listed shares, which is really what I'm doing, then you've got you can trade these shares. You can go on your computer and sell them today, and you've got depending on the settlement period, you've got the money in your account probably 2 or 3 days time. So there's a lot of sort of benefit to this sort of asset class. I mean, I think people should also look at the currencies as well, because quite a lot of people have got overexposure to their own currency. The house maybe, right, let's say, in US dollars, their business value is in US dollars. So they may think, well, actually, that's great, but I wouldn't mind having a bit of exposure to a different currency. And through commodities, because they're global, you can do that.
So when you're dealing with your clientele, and you're talking with your clients, what are some of the questions that you wish that they were asking you when they first start out, but they're not?
That's a superb question. I think I always ask them what they want, and if I'm honest, quite a lot of them don't know. Right. And it's only when I kind of ask the question, say, well, what do you want to do? And they say, well, I want to invest in commodities. And I said, well, what do you want to achieve? And you get some people who say, oh, I want to make loads of money, and I want to speculate, and they're very young and they've got time, and that's great. But then you get other people who are a lot older, and they say, well, look, I like a bit of fun, but I really want to try and keep my money and help it grow and get a dividend. And it's really important to know that, because it really kind of drives what what I'm looking to do and looking to achieve.
Right. So what are some of the common mistakes that people make when they try to enter into the commodity sector?
Well, I think one of the biggest mistakes that people make is they think they can't lose, and especially in a bull market. In a bull market, you could literally get a newspaper with a list of commodity companies, put it on a dartboard, throw a dart at it, and you'll probably make money. It's a bit like the real estate world.
Right.
When it's in a boom, you don't really need skills. People buy a house, they paint the bathroom, change the carpet, and then they sell it at a 30% profit, and they think they're a property developer. And I'm sorry, but you're not. But it's commodities are the same, and I think I was told never love anything that can't love you back, and I can assure you that commodities and property,
Right.
they don't love you back.
Right.
And so one of the skills really is to sell at the right time. I had a client this week who had made a fortune out of one of the stocks that I got them into, and he said, "Well, what should I do?" And I said, "You've got to sell it." And he sort of said, "Well, look, it's made me loads of money." I said, "Well, no, you've got to sell it." And he didn't like it. He's like, "Well, it's made me loads of money. I love this stock." And I said, "No, you've got to sell it." And so yeah, he sold it. And he's the stock he sold out of has gone down, and I put him into something that's almost doubled in value. So, but people people do get attached to these things, and you do need to sell, because commodities are cyclical, and if you're not careful, you'll have way too much money in it because it's done far too well. If we get another bull market, and then if we get a crash, you perhaps start off putting, let's say, 10 grand in, you then put 50, then put 100, then put a million, and then it crashes, and you could lose a lot more than you ever thought about investing in the first place. So
Right.
You need to look at your end game, not your start game.
Right. I like your saying there about, don't love something that doesn't love you back. I may have to use that. Because you were talking about, people needing to get out at certain times and things like that. Is there a particular time that is the best time to invest in commodities, or is it just one of those things, get started?
Yeah, I think, you need to look at cycles, and that's why, I said at the top of this, you should look at like the Goldman Sachs index, because, that's a massive index, and it indicates that, now is a good time to be looking at stuff. You need your hand holding in most cases, because it's a new sector for you. I'd say it's as much about psychology as investing, because, as I said, telling people to sell, sometimes they don't like it. And I had one guy who phoned me up to say thank you because I'd made him 300% on something, and I said, "Well, you haven't sold it, have you?" He said, "Well, yeah, I've never done this before. I made 300%." And I said, "You lunatic, that stock, it went up to close to 3,000%, and he can never get back in because it just moved too quickly." And it's very difficult psychologically to buy something at 30% more than what you could have bought it for yesterday. And certain stocks, if they make the kind of a huge discovery, they can do that. Others go up on discoveries nearby, and I think that that's where my kind of expertise adds value, because I look at why a stock's gone up, and if they found a phenomenal deposit, you probably want to hang on to it. But if they've gone up because of market sentiment or for other reasons where I'm less confident that they're going to stay up, then I probably sell out, and my subscribers would do likewise. So
Sure.
yeah, they're all different, and I think that's what people need to understand. One commodity company is completely different to another, even if they're producing the same commodity. And it's important for people to realize that.
Going back to the investor themselves, who should be investing in commodities?
I think people, for me, I think they need a minimum of like $10,000 to look at the sector. as an amount. And I would say, you probably want to have 2,000 in cash in case the sector crashes, so you've got a bit of dry powder. If it really takes off, you won't care about having 2,000 in cash. But that leaves you with 8,000, so you can get into 8 different stocks. What I like about it is, you want to be in different countries, you want to be in different commodities. So, you perhaps have a bit of exposure to gold, a bit of silver, a bit of rare earth, a bit of uranium. And so you're exposed on a currency basis, a geographic basis, commodity basis. And, even though you can say I've got a commodity portfolio, to someone looking in, they may say, well, it's a lot of money in commodities. But if you've got them across lots of different countries and different commodities, you've actually got diversification kind of within diversification. So I think providing people can afford to allocate at least that amount to a sector, that's the first thing. I think the second thing is, your financial advisor should tell you this, but you don't want to, it's a very volatile market. You don't want to be putting money into something where you need the money pretty quickly. And, I had a mate of mine who said, look, I've got a whole load of money for my kids' school fees. Can I put it with you? And I said, absolutely not. I don't really want to have that on my conscience. Right. So I think that you kind of, you need to have a bit of money where, the famous line, you can afford to lose. No one can afford to lose money, but, right. But you do need some money that's not part of your day-to-day life. And because of the volatility of the sector. But if you've got a broad enough portfolio and you're disciplined enough with it, you can have a lot of fun.
So it sounds like, because I know I tell people that are starting up businesses and things like that one of the reasons why most businesses fail is because they're undercapitalized when they start out. Is that kind of the same thing when somebody goes to get into the commodities market? I mean, you're saying they should at least start with 10 grand. Is that, one of the things that they're too hesitant to put enough in there to make a difference?
Yeah, you've got to be careful. I mean, you could easily just put a few thousand in, a couple of stocks, and they may not perform, and you then need the money to put a deposit down on a house or something, and that's not what you should be doing in this market. This is for people who've got assets elsewhere. Yes, the returns can be fantastic, but don't go into it on that basis. Go into it as a way of diversifying your portfolio. If you make a shed load of money, fantastic. But I think that's one of the problems that people have. I know people have gone into digital currencies and things like that. And yeah, good luck. If they do well, fantastic. But diversity is important. So you do need enough. And as I say, I think $10,000 for me is kind of the minimum. Mm-hmm. Some people may want to go in with less, but given I've got a subscription fee on top of that, and they've got trading fees, buying and selling shares. That you don't want to have too little in the game. So yeah, I think that's a useful minimum.
So what are some of the other common mistakes that people make when they get into the commodities?
I think not looking at where the assets are is a very common mistake. Someone will look at something, it's got great grade and huge deposit, but it could be in a very remote part of the world where there's a lot of political risk, and suddenly that asset gets nationalized and their investment goes to zero. That's one of the big mistakes. Another big mistake is people get very excited by a deposit perhaps in a safer jurisdiction, but if there's no infrastructure, so there's no power nearby, there's no roads nearby, there's no water nearby, then they're going to have to get that in order to process it and extract the ore. And if it's not feasible to do that, in Australia, there are parts of Australia where it's very difficult to get water. And so you do need to look at all these other things. And even if there's a fantastic deposit, if it's going to cost 200 million to build a pipeline for water, first of all, you've got the cost of it. Secondly, how on earth are you going to raise that money? It's going to be very difficult. Someone's going to have to put their hand in their pocket for, let's say, 100 million to build a pipeline for you. That could be a huge risk, because the pipeline, if it's going over someone's land, they need a permit for it, and you only need a few people to say, actually, no, I don't want that going across my land, or if it does, I want you to give me this compensation, and it can get very complex. So there are a lot of moving parts for any company that people are looking to invest in.
Now, how has COVID affected your business?
I've been quite fortunate. It hasn't affected it too badly. Some mines have had to shut down, but I'm pretty careful about. I use what I call the bridge system, which stands for balance sheet, resources, infrastructure, diversification, grade, and exploration potential. Now, in this case, diversification is quite important, because you really want more than one mine, ideally in a different country. So if a mine does have to close because of COVID, then at least they've got a way of operating and generating cash through another mine. That's also relevant in terms of I say balance sheet, because you don't want a company with lots of debt repayments over the next couple of years, because if COVID means that they've got to shut mines and they're not producing cash, banks may have some sympathy, but they won't have a huge amount of sympathy if they're owed money. Then I'm not sure what the force majeure is different in different countries, but if they're owed money and you can't pay it, you could be in a spot of bother.
I've asked you a lot of questions. We've covered a lot of ground. I mean, what have I not asked you that you wish that I had?
I think you pretty much covered it. I mean, I think the main attraction for me, and I think if you look at commodities versus more, let's say, traditional asset classes, so real estate, bonds, and more conventional equities, it's one of the few asset classes, as I keep referring to the Goldman Sachs index, but it's one of the few asset classes where there is potential. If you look at it, it's nowhere near the top of the curve. And I think that people really need to kind of look at that and sort of think, well, if I've got spare capital, do I want to be putting it in something that is, if you look at the property market or the bond market or the equity markets, they're pretty close to highs. And given we're in a pandemic as well, with all this money being printed, do you want to put more money into these markets? And I think that's why the commodity market is a market people should be looking at, and a lot of people have got no exposure to it whatsoever.
Right.
And I think that they should at least look at it.
I like that idea, especially with people that they have so much money tied up in their business, and it's we're in the U.S. and it's tied up in all of that to diversify, like you're saying, in some of these commodities, because they're in other countries, and it really helps diversify things.
Yeah, absolutely. And diversity is a kind of, I think that's a buzzword here. People do need to think about sort of what they're doing and how their how their investments are, where they are, and make sure that they've got some bases covered, so they can sleep at night.
Right. So, Simon, if our listeners like what they hear and they would like to talk to you or even subscribe to your intelligence report, how do they get to you? How are they able to subscribe to your report?
Right. I mean, the best thing to do is if you go to www.brookvillecapital.com. On there, I've got a whole load of reviews. I'd suggest you look at the website, read the reviews, and get comfortable with what I'm doing. I think that's a good starting point. If after that they're still interested, what they can do is they can book a call, and we can have a chat and make sure that this is something that I think is for them, and they know what they're getting from me as well. And then I think after all that, they should subscribe. And if they do subscribe, they get a weekly newsletter. They get a free copy of my book. I put them on my Slack channel, so there's a forum with a whole bunch of investors, like-minded people, which they find pretty useful. And they get a password for all my previous reports. So not only can they look forward, but they can also look back, which people like.
Well, I really appreciate your time today. This has been a lot of interesting information, and definitely something that I haven't looked at before. So I really appreciate your time and your expertise.
Well, thank you very much. Really enjoyed it.
So today our guest was Simon Popple, who is the managing director of Brookville Capital and also the writer of the Intelligence Report. Thank you.
This show has been produced by Market Domination, LLC. To discover how you can have your own show completely done for you and turn it into a real published book and become the authority in your marketplace, go to www.marketdominationllc.com/podcast offer.